$3,000. That's the most investment loss the IRS lets you write off against your paycheck this year. It was $3,000 in 1978, too.
Wait, the exact same number? For almost 50 years, through every recession, every bull market, every round of inflation, that number just sat there?
Sat there, untouched. From Trek for Wealth, this is the podcast. I'm Grant.
I'm Avery, and today we're talking about tax loss harvesting, how you actually turn a losing investment into real money back at tax time, and why the rule governing it is way older and way stranger than people assume.
Which, after the silver crash we covered a few weeks ago, might be extremely relevant to some of you right now.
Right. If you bought silver up near that $121 peak and you're sitting on a loss today, there might actually be a silver lining. No pun intended.
There was a pun intended.
There was absolutely a pun intended. But here's what's wild, and it's the whole reason we wanted to do this episode. The rule that decides how much of that loss you actually get to keep goes back over 100 years, and almost nobody who uses it has ever heard the story. Let's get into it.
1921. The U.S. is climbing out of a brutal, sharp recession. Stocks had cratered the year before, and a lot of wealthy investors had figured out a very clever trick to soften the blow at tax time.
Okay, hit me. What kind of trick are we talking about here? Something shady or something that just looks shady in hindsight?
The British had a name for it: bed and breakfasting. You'd sell a stock on December 31st, right before the market closed for the year, to lock in the loss on paper. Then, the very next morning, bed and breakfast later, you'd buy the exact same stock right back.
So nothing actually changed in your portfolio. You still owned the identical stock the next day at basically the same price.
Nothing changed except your tax bill. Your holdings were identical. Your risk was identical. Your deduction, though, was very real.
I mean, that just feels like cheating with extra steps.
Congress agreed with you. The Senate Finance Committee's own report called it evasion through the medium of wash sales. That's the actual language from 1921. So the Revenue Act of that year made it illegal. Sell a stock at a loss, and if you buy back the same or a substantially identical security within 30 days before or after, the loss gets disallowed. They named it the wash sale rule.
And that exact rule is still the law today?
Same core language, 105 years later, codified now as Section 1091 of the tax code.
Okay, but you opened with 1978, not 1921. Where does that number fit into this story?
That's the second half of it, and it's really a different rule stacked on top of the first one. Back in 1976, Congress said, if your total losses for the year are bigger than your total gains, you're allowed to use up to $1,000 of that leftover loss against your regular paycheck income. By 1978, they'd raised that ceiling to $3,000.
And then just never touched it again? Not during any of the recessions since? Not during any of the big inflation spikes we've talked about on this show?
Not $1 of adjustment since. The Congressional Research Service actually ran the inflation math on this. If that $3,000 cap had simply kept pace with prices since Jimmy Carter was in the White House, it would be worth roughly $13,000 today.
So the person selling 10 shares just to break even, and the hedge fund running a 200-stock tax strategy, they're technically using the exact same rule. It just doesn't cost either of them the same thing.
And that's exactly where this gets interesting, Avery. Because the wealthy did not stay stuck at $3,000 for very long. They found the gap in the wash sale rule almost immediately.
What do you mean, the gap? I thought you just said the rule closed that door back in 1921.
ProPublica broke this story wide open a couple years back. A strategy some of the major banks run for ultra-wealthy clients, literally called tax-advantaged loss harvesting. Here's how it works. Take a company like Shell. Shell has two different classes of publicly traded stock, technically distinct securities, different tickers. but they trade almost perfectly in step with each other because they're the same underlying company.
Wait, so you could sell one class of shell stock at a loss, on paper claim you've exited the position entirely,
And buy the other class the very same day. Legally, under the wash sale rule, those two tickers are not substantially identical. Economically, though, you never actually left the position. You're still exposed to Shell, still tracking the same company.
that is the bed and breakfast trick from 1921 wearing a legal disguise.
Basically, yes. Goldman Sachs reportedly ran hundreds of these paired positions across dozens of companies for billionaire clients like Steve Ballmer, constantly harvesting losses off the market's natural volatility, saving enormous sums in taxes, year after year after year.
Okay, so what does any of that actually mean for someone listening right now who is very much not running a hedge fund out of their kitchen table?
It means the underlying tool is completely legal, and it's yours too. You're just going to use a simpler, smaller version of it. Let's walk through the actual playbook.
This is the part I actually want people to screenshot because it's the part they can genuinely use before December 31st this year. Not some abstract policy debate, an actual checklist.
Move 1. Harvest your losers before year end. If you're sitting on an investment that's down and you don't have strong conviction it's coming back, selling it before December 31st locks in that deduction for this tax year specifically.
But per the 1921 rule, you can't just turn around and buy it right back the next morning.
Right, that's move 2. Respect the 30-day window on both sides of the sale. Sell, wait at least 31 days, and only then are you clear to repurchase the exact same security without the IRS disallowing your loss.
Okay, but realistically, what if someone doesn't want to just sit in cash for an entire month, missing out on whatever the market decides to do next while they wait?
Move 3. Swap into something similar, not identical. Sell an S&P 500 index fund at a loss, and same day buy a different total market fund that tracks almost the same broad market. You stay fully invested. You're not substantially identical under the rule, and the loss still counts.
Okay, and once you've actually banked that loss, where does it go? What does it actually do for your tax bill?
That's move 4. It offsets your capital gains first, dollar for dollar, with no limit at all. Whatever loss is left over after that, up to $3,000 of it comes straight off your ordinary income, your paycheck. And anything past that $3,000 ceiling doesn't disappear, it carries forward indefinitely into next year and the year after that for as long as it takes to use it up.
Forever? There is really no expiration date on it? No use it or lose it clock running in the background somewhere?
Forever for an individual. Some investors are still carrying forward losses from the 2008 financial crisis, using a little bit of them every single year.
Okay, last one, because people ask us about this constantly. What about crypto? Does any of this apply the same way?
Here's the twist, and it sounds familiar. The wash sale rule, remember, technically only covers stock or securities. The IRS classifies cryptocurrency as property, not a security. So right now, in 2026, you can sell Bitcoin at a loss and buy it back that same afternoon, and the loss still counts for tax purposes.
So there's no 30-day wait at all on the crypto side? None of the 1921 rule applies?
Not yet. Congress has proposed closing that exact loophole more than once, and it could take effect as soon as the 2027 tax year if it passes. 2026 is also the first year crypto exchanges are required to report your trades directly to the IRS on a brand new form. So, move 5. If you're using the crypto gap while it's still open, keep it clean. Let real price movement happen between your trades. trade on the open market, and keep documentation. The IRS has a backstop called the economic substance doctrine for trades that exist only on paper with no genuine risk.
So let's do both sides here, because I think there are two separate fights buried in this episode. First, is the crypto loophole actually a problem, or is it fine as is?
Both are real, defensible arguments. One side says crypto is legally property under current law. Investors are simply following the rule exactly as written, and it's Congress's job to update the statute, not the taxpayers' fault that they haven't yet. The other side says a trade that's economically identical to a stock wash sale shouldn't get completely different tax treatment just because of which asset class it happens to be wrapped in, and that closing the gap would raise real, meaningful federal revenue.
And the second fight, back to where we started this whole episode, raising that frozen $3,000 cap. Is that a slam dunk, or is it more complicated than it sounds?
Same kind of split. Raising it would genuinely help everyday investors get through a rough year without eating the full tax hit on top of the loss. But the data also shows capital losses, like capital gains, are heavily concentrated at the top of the income scale. A small share of taxpayers hold the vast majority of both. So a higher cap helps ordinary investors some, but it helps wealthy investors quite a bit more.
Preparing without predicting, right? None of this requires you to guess where the next crash or the next silver squeeze is coming from.
Exactly right. You just need to know the rule exists and use it honestly every single year you happen to have a loss sitting on the books. The history of the wash sale rule is really the history of Congress writing a law specifically to stop the wealthy from gaming their taxes, and the wealthy hiring smarter accountants within the year to write around it.
So where does that leave the rest of us? Listening to this on a Tuesday with one down position in a brokerage account somewhere.
With the exact same tool, just built for a smaller portfolio. $3,000 a year against your paycheck, unlimited against your gains, and a rule that's been sitting there patiently since 1921, waiting for you to actually use it. Preparing without predicting. Always.
That's Trek for Wealth. Keep trekking.